Right, good day, grade 12s. Today we are doing the last lesson on chapter 6. All right. Okay, so we are just going to look at different investment concepts and their descriptions. And then towards the end of this lesson, there's a very, very important section on the calculation of interest. So the first concept that we're going to look at is debentures. Debentures is issued by companies to raise borrowed capital from the public. All right, so instead of a company borrowing money from a bank, they're going to borrow money from the public. Now, it is not the same as shares. All right, when you are a debenture holder, you are basically lending money to the company on certain conditions for a certain period of time. As the lender or the debenture holder, for you, it is an investment that you are making. You are basically lending your money to the company. The company gets to use this money and do whatever they want with this money. And after a certain period has passed, they will give you your capital amount back, obviously plus the interest that you have earned over that period of time. When you are a debenture holder, you are a creditor of the business because the company owes you money. All right. The difference between a shareholder and a debenture holder is that a shareholder is part owner of the company and a debenture holder is a creditor. All right, so the company is liable to repay the debentures. The holder of the debenture will be receiving his money back after a certain period of time. Most of these debentures can be traded on the JSE. So if your investment period is not yet over, but you would like to have your money back, you can offer it for sale on the JSE to see if there's anybody else that would be willing to buy this debenture from you. And then obviously when the company pays out, when the investment period is over, the person who bought this debenture from you, that person will receive the money. Right, as I said, debenture holders, because you are lending your money to the company, for you it is an investment and your return on investment will be your annual interest payments. All right, so based on the amount that you lend the company, you will earn a particular interest percentage that they're going to be paying out to you annually. Every single year you will receive your interest payments for the duration of your investment period. And then when the investment period is over, obviously you will get your capital amount back. Right, when we talk about dividends, remember your dividend is the return on your investment that you receive if you own shares, if you are a shareholder. All right, so when a company does declare a profit at the end of their financial year and the board of directors do decide to pay out those profits, as a shareholder, you are going to receive your share of the profit in the form of a dividend. All right, as I said, your dividends are decided on and managed by the board of directors. And remember, we've done the different shareholders now. Sometimes if you're an ordinary shareholder, the value of the dividend would differ, obviously. If the company makes more profit, your dividends will be higher. Just remember, your dividend is never guaranteed as an ordinary shareholder. In some cases, with the preference shareholders, their dividends is fixed and it is guaranteed whether the company makes a profit or a loss. But generally, your dividends will only be paid out to your ordinary shareholders provided that the company made a decent profit and only if the board of directors decide that they are going to do a dividend payout. Right, when we talk about a capital gain, capital gain means it is the return on the property or a fixed asset or an investment that you have bought. All right. So in other words, when there is a capital gain, when you buy property, for example, it would mean that you bought a piece of property, a piece of land for 500,000 Rand. And when you sell it 20 years later, it is worth R1 million. The value of your investment has increased. Your capital has gained value. Okay, any fixed asset or property will work like that. Other investments can also work like that. Shares, for example, if you bought shares in a company and you paid 5 Rand per share when you bought the shares, 10 years down the line when you sell the shares, you earn 20 Rand a share. Obviously, the value of your investment has increased. All right. But in our tax system, when you sell your property, whether it's a fixed asset, whether it's shares, and you have had capital gains, you are also due to pay capital gains tax. Okay, it was a relatively new tax. It was introduced, I don't know, a while ago. Okay, it's already a couple of years. But when capital gains is made, when you sell that asset, when it has increased in values, you are due to pay capital gains tax. The capital gains tax will only come in when you sell the asset. While your property is gaining in value and you're still owning it, it makes no difference. There's no capital gains tax. The tax only becomes payable when you sell an asset that has increased in value. All right. And literally only the gain, a part of the gain is taxed. All right. So if you sell it for $1 million and you bought it for $1 million, you sell it for 2 million, your profit, your capital gain is $1 million, a certain percentage of your gain will be taxed. Now, it is a wealth tax that is used in our tax system where the government is trying to create a more equal distribution of income. All right, so when you sell it, that is when the capital gains tax becomes in play. Right, now if we go to the interest principles, okay, this is very, very important. Right, when we refer to simple interest, the interest is calculated only on the original amount that is invested. That original amount, we call it the principal amount. Okay, so the amount that we are now going to invest, or the amount that we are going to save, interest is only earned on that amount that we are investing. So the principal amount stays the same over the entire period of investment. Now, if you've made a deposit of 10,000 Rand, every year you're going to earn your interest on 10,000 Rand. Next year, you're going to earn your interest on that 10,000 Rand. 5 years later, you're still earning interest on that 10,000 Rand. The principal amount remains the same. The interest is kept separate. Okay, it's either paid out to you on a yearly basis or it is kept separate unless it is reinvested. Okay, so if you are receiving this interest and you make another investment with this interest, obviously then it's a different story, right? But the interest that you are earning is kept separate. Okay, it's not added to the principal amount. It is kept separate. When we do simple interest, you will see, remember, interest is your return on your investment. It is the passive income that you are receiving when you're making an investment. And you obviously want the highest return on your investment, because that is the money that you receive. The more passive income you receive, the better. But when we use simple interest, you will see when we do the example at the end of this lesson, your return is actually smaller. Okay, over a given investment period, when simple interest is calculated, it is going to be less than your compound interest. All right, if we look at compound interest, this is when your interest is calculated every single period for the duration of your investment period on the principal amount plus any interest that has accrued from previous periods. All right, so now your principal amount is getting more and more. Every year, the interest that you have earned for the previous investment period, for the previous year, it is added to the principal amount. So the principal amount on which you are earning interest is growing. It's getting bigger and bigger every single year. You are basically earning interest on top of your interest. You are earning interest on your principal amount and you are earning interest on all the previous periods worth of interest. All right. So because your interest is added to the investment after every period, after every year, your capital amount, your principal amount is going to increase. Right, if we look at the difference between compound interest and simple interest, and this is something that they ask quite often. First of all, we said your compound interest is when you earn interest on the original amount invested, your principal amount, as well as any interest that was earned in previous periods. Now, the interest gets added to your principal amount after every single year. When it comes to simple interest, obviously we are earning interest only on the original amount. Okay, we are only earning interest on your principal amount. With compound interest, because your interest of previous periods are added to your principal amount will grow every single year. Your principal amount is getting bigger as we are adding interest. With the case of simple interest, your principal amount stays the same. Remember, we said your interest is kept separately, so your principal amount remains the same over the entire investment period because nothing gets added to it. Your interest is kept separately. Right, your compound interest, you are calculating your interest on a higher principal amount. Okay, so every single year you are calculating your interest now on the principal amount plus last year's interest. And then once you earn interest now in the second year, it is added again. So in the third year, you are earning interest on your principal amount plus the interest of the first year plus the interest of the second year, and then again it is added. All right, so every single year when you calculate your interest, that interest is added to the principal amount. All right, so the principal amount keeps growing. In the case of simple interest, your interest is kept separate. Okay, it's not added to the principal amount. When we use compound interest, it yields a higher return on investment. And as I said, you will see that when we do the calculation now, that the interest that you receive when you calculate it with a compound interest rate, it is always more than a simple interest rate. The simple interest always gives you a lower return on your investment. All right, so the total amount of interest earned at the end of the investment period, if you look at all the interest that you earned over the investment period, when you look at the compound interest, it is always going to be higher than the simple interest. Okay, with the simple interest, the amount is always going to be lower than compound interest. Okay, I'm going to do one example with you, and then you are now going to continue with your activities, your informal activities that I sent the other day for chapter 6. Okay, so if we look at our scenario, it says Renette wants to invest 30,000 Rand in a fixed deposit for 2 years. She approached 2 banks. Saints Bank offered her 12% simple interest per year, and Caprica Bank offers her 12% compounded interest per year. Right, so we are expected to calculate the interest that Renette will receive after 2 years if she invests with Saints Bank. So if we use a simple interest rate, we also have to calculate the interest amount that Renette will receive after 2 years if she invests with Caprica Bank, where she gets a compounded interest rate. And then we have to recommend the best investment option for Renette, obviously motivating our answer. Okay, so if we calculate simple interest. Okay, the formula that we are using, this is the formula, and remember you need to know your formulas. This is not science and maths where formulas are given on your cheat sheet. You get no cheat sheet, you must know your formulas. Okay, so your interest rate is P times R times T. The P is your principal amount that is invested. The R will be the interest rate, and the T will be the investment period in years. All right, if we use that for our scenario, we substitute into the formula. Okay, now when we do calculations in business, it works differently to economics. Okay, remember in economics, you always must show your calculations. In business studies, if you even don't show your calculations but your answer is correct, you will get the full marks. But, when you show your calculation, if your answer is wrong, they can give you some of the marks, even if your answer is wrong. But if you only show the answer, you're going to get 0 if your answer is wrong. So it is always advisable to show your calculations. You write down your formula, then you substitute the figures in there, and then you get your final answer. All right, so if our formula is P times R times T for simple interest, our principal amount was the 30,000 Rand that Renette would like to invest. Our interest rate is 12%. Now you need to listen to me carefully. We don't multiply by 12. All right, it's 12%. And 12% means 12 over 100. You can't times by 12, then you're going to get the wrong answer here. Okay, 12% means 12 over 100. That is 0.12. So if you don't want to write 12 over 100, you can write 0.12, but you cannot just write 12. And then the T, your investment period, is for 2 years. So 30,000 times 12 over 100 times 2 means that a simple interest after 2 years, she would receive 7,200 Rand. That is the interest that she will receive. Obviously, she will get her capital amount back as well. All right, you must look at what they're asking, right? In this case, they want to know what was the amount of interest that she would receive, and that would be 7,200 Rand. Right, if we go to the second calculation, the compound interest, when we do compound interest, there's two different options. Okay, option one is easy if your investment period is short. Okay, then the formula is going to look like follows. In year one, you're calculating simple interest. All right, you are just calculating simple interest for year one. So P times R times T, the principal amount is 30,000 Rand. The interest rate was 12%, so 12 over 100 or 0.12, not 12. And then if we're just doing it for the first year, it is times 1. Okay, I didn't put it in here because it's times 1, right? That is going to give you 3,600. So for the first year, because it is the first year, interest hasn't compounded yet. It's the first year that we are earning interest for. So we calculate simple interest. In the first year, she will get 3,600 Rand. But in year two, she's now supposed to be paid interest on her principal amount plus the interest earned in the previous period. So now you're going to take this 30,000 Rand, which is your principal amount. You add the interest for period one, for year one, that 3,600, you add that. Now the principal amount has grown. 30,000 plus 3,600 gives you 33,600. The principal amount, the amount on which she earns interest in the second year is now 33,600. Interest rate is still 12%, not 12 over 100 or 0.12. And if you do that calculation, it gives you, for the second year, she's earning 4,032 Rand interest. The question is, what was the total interest that she has earned over the 2 years? In year one, she earned 3,600 Rand, plus in year two, she earned 4,032. And if we add that together, we get 7,632. Okay, now this method is doable if your investment period is 2 years. But your investment period is 20 years, this calculation is going to become very, very long, and it's going to be inevitable that you're going to make a mistake somewhere. All right, you're going to forget to add something, you're going to make a calculation error if you have to do this for 20 years. So if it's a longer investment period, this is your better option, option 2. Okay, the only thing with option 2 is that you need to study the formula. Okay, you need to know your formula. You do these formulas also in maths or math lit somewhere, right? But just be careful. This in business, you have to use this formula. You are not allowed to use another formula. So if your maths lit formulas looks different, then you have to study this one. For business, I know it's stupid, but you have to use this one. Okay, so what does our formula say? The interest, compound interest, is P times, in brackets, 1 plus R, close your brackets, to the power of N. P still stands for principal amount, the original amount that is invested. Okay, the R is your interest rate, the percentage, interest rate. Rate means percentage. Okay, N is your investment period in years. All right, so when we substitute that in our formula, okay, again, as I said, it's always a better idea to write down your formula and to show your calculations. Okay, especially if you made a mistake, at least you can get some marks instead of getting no marks at all. All right, so you write your formula and then you substitute. The principal amount is 30,000 times 1 plus our interest rate R is 12%. Again, either 0.12 or 12 over 100. Okay, you can't put 12. That's going to give you the wrong answer. 12% is 12 over 100 or 0.12. Close the brackets to the power of 2. All right. And now obviously with your modern calculators, you're just going to put this into your calculator and it will sort out the order of calculations, right? But remember, you need to do brackets first. Okay, brackets first, then the exponent, and then you're going to multiply by 30,000. But if you do that, and I want you to do that physically when you watch this lesson, you take your calculator and you put this into your calculator and you make sure that it gives you this answer so that you do it correctly. All right, the answer is also going to be 7,632, same as option 1. Okay, they must give you, it's two different ways of calculating the same thing, so it must give you the same answer. In an exam, obviously you're going to choose which method you want to use, option 1 or option 2, if it is compound interest. Right, so then last question was we have to make a recommendation. Obviously, we are going to recommend to Renette to go and invest her money with Caprica Bank, where she can earn compound interest, because the compound interest is higher. It's 7,632 Rand compared to the 7,200 Rand that she's going to get if she gets your simple interest. Net compound interest gives you the higher return. Remember, investors want to receive the highest return possible. Okay, so when they get the highest return, they will do that with compound interest. All right.